Ladies and gentlemen, welcome back from the coffee break. And I would like to open a second panel of today's conference. This panel is going to be dedicated to bonds. And bonds is something we in Signet Bank are very much focused on. So I'm very much looking forward to an interesting discussion, interesting ideas, interesting insight on the bond markets in the Baltic countries. So I would like to introduce the moderator of the panel, Dalia Augaite, associate partner at TGS Baltics. Dalia is an expert in capital markets and financial law, specializing in developing securities and investment insurance products. Over the past few years, Dalia has participated in major projects related to the issuance of bonds and their listings on the Nasdaq-regulated and First North markets. She advised Ministry of Finance in preparing the draft loan securitization and covered bonds, and preparing recommendations for the Lithuanian Sustainable Financial Action Plan and proposals for improving the Lithuanian investment environment for institutional investors. Quite a lot of credentials. The floor is yours.
Thank you, Robert. Welcome back from the coffee break. And this hour will be dedicated for the debt capital market. Myself, I'm living in capital markets like for 15 years, but I'm mostly exciting when those transactions, they combine all our Baltic region. And that's why we are here from Lithuania to Latvia. This is the most exciting thing to discuss with you. The aim of this panel discussion will be to, at the beginning, we will overview what is the current situation in the market. Afterwards, we will focus more on the issuer's perspective, what is important when you decide to go first time and raise capital from the debt capital market. And afterwards, the best thing is to share the experience from the companies who are already in the market. Don't talk, I'm not going to talk a lot. I'm the moderator. My main task is to manage the time. So now I would like to welcome on the stage persons who are leading the companies through the whole process and that ensures that the process is smooth. So Luminor, representative from the Luminor, Paulius Zurauskas, he is the head of capital. Also, we are having Kristiana Janvare from Signet Bank, head of investment division. Also, Aare Tammemae. I'm sorry, Aare, if I'm still pronouncing your surname not in the right way. The partner from the Redgate. And also, I'm inviting presenters of the case studies and sharing their experience. Viktorija Meiksane, she is the CEO of Coffee Address, and Paulius Stonis, EPSO-G head of sustainability. As we are serious people, we'll talk about serious things, but nevertheless, I like to start some conversations with a joke. And usually it's very important to talk about serious things in simple words. And sometimes people from the business, they are asking, what is the difference if I raise capital in IPO process or from debt capital market? Not even looking that it is the share capital or debt money. I'm saying, usually when you go to the marriage before, you have the engagement. So going to the capital market is a limited time of period when you are on the market, and still you have an option to go back. When you go to the equity market, is the marriage for your whole life. So this is the simplest starting point for us. But before starting our discussion, let's base the background on which we base our further thoughts our insights and sharing. So, Paulius, I would like to give you the tool and give us the short overview, what is today.
Thank you, Dalia. Good day, dear audience. Thank you, organizers. Big pleasure and privilege to be here. Just to set the stage and for the context, in terms of capital markets, the storm is no longer coming. We are at a perfect storm. And I had to come up with a title here. I had to make sure that I come up with something also a bit positive. So we are dancing at a perfect storm. And I'm sure we will be dancing later tonight. I'm sure colleagues are organizing a good after party. And reflecting what Ivars was saying on equity side of things, we have achieved so much over the last couple of years. We really deserve a good party tonight. And we finally met here in Riga at the epicenter of Baltics, discussing capital markets here. Gentlemen prefer bonds. I see Aare is nodding. So let's talk bonds. And just to give you a bit of international European color before we drill into local market and how it developed over the last few years. And obviously we can further discuss at the panel how it will develop onwards. Looking at the euro market, basically the corporate market can digest around 200-400 billion euro a quarter of new insurance supply. And I say 2019, 2021 have been a golden years for the market. We had the landscape with ultra low rates, negative rates, which in my view doesn't make any sense, and I'm quite happy that change is happening. We also had quantitative easing, the support from central bank, what was also coming directly into corporate space. And then the clouds started to appear in Q1 2022. And you see 2022, Q1, people were rushing into the market. And it was a bit of a feeling that the door is closing and the clouds are coming. And in terms of new issuance, you see quite a massive decline. And the market is now primarily dominated by really top-grade, high-quality financial institutions issuing covered bonds from financial sector. And the corporate space is very, very narrow. Same chart from different perspective, even more gloomy one. You see that the sub-investment grade, high-quality, high-yield issuers pretty much can no longer access the market. The market is already dysfunctioning. Only 5% of total volume originated was below investment grade in Q3. Something to cheer about a little bit from the region and to be proud of is Maxima Group trade that happened in July. It was the only transaction from the rating category from Central Eastern European region, Baltic region, and also one of the very few transactions in European market. Obviously with big help and big support from local community and the supranational investors participating in that deal. We will discuss obviously later in the panel, and we have very good presentation by Paulius from EPSO-G, sustainability topic. It's definitely happening. It's a big mega trend. I would even characterize it as it's becoming a real market convention. So best practice is a normal market practice these days. And in older days, it used to be that if you want to reach institutional credit market, credit rating is a passport to the market. Nowadays, without strong ESG credentials, without a story, and also legal side of it, we can touch a bit later, it's pretty much becoming very difficult, especially in the stormy market, to access the debt investors. Green bonds is nothing new. Right? Baltics were actually one of the first areas where they started to develop with Latvia Energo in 2015, Ignitis following through in 2017. But you see that sustainability link notes we will touch a bit deeper here today. Picked pace also in 2019. And we have seen market with ESG element reaching 43% in Q2 this year. And I think it's a clear one-way train. It will continue to grow and develop. Now, zooming down and coming closer to the Baltic states, I always like to draw a parallel and compare it, because it's a 41 billion euro market, right? Largely represented by sovereign issuers, which we will not talk about much in this conference. Probably it's just worth to mention two things. Sovereign bond market, well-functioning sovereign bond market is also very crucial and key element for the market development. And we can be pretty proud of that all the sovereign states are successfully issuing debt for many, many years, and also congratulate Estonia with their repeat issue from yesterday. Benchmark size 1 billion euro 10-year issue. So Estonia is now also becoming a 2.5 billion euro issuer from Baltic states. It really paves the road to international investor community that later corporate issuers can access. So we are quite comparable to Finland in terms of population, more or less similar, more than 2 times smaller in terms of GDP, but in terms of size of the market, we are around 10 times smaller. To me, it is a bit of a benchmark, it is a bit of ambition level, and last time we visited investors in Helsinki, we were discussing this and saying that it will take us, looking at the pace, how fast we grow, it will take us another 10 years and we will catch up with Finland. Now when the storm came, I'm a bit more humble, but I think we'll continue to work hard on pushing on and getting there. I think this one I can probably skip, but one important note here is that 2021 we have succeeded to reach quite impressive more than 2 billion euro volume originated from the corporate issuers from Baltic states. And quite big chunk of that is with some sort of ESG label. Maybe a bit of story where we are coming from, right, and why it's important. I would characterize that all the way till 2018, it was a bit of a dark ages or darkness, because the market was really dominated by state-owned utility companies. You name a few, but they were pretty much the only one who could issue debt in the international market or institutional market. And then 2018, I would say, was a bit of a breakthrough year, with Maxima Group hitting the screen and successfully pricing the international bond transaction from the private sector. And I think since then, the market really started to flourish. And many Baltic borrowers have used this great opportunity to lock in long-term rates at the levels that were so favorable a couple of years ago. And you see now the spectrum of things exploding pretty much, right? The utilities used to dominate and used to comprise more than 90% of the market. Now you see different sectors, BT, Air Baltic, Granul Invest, Acropolis, issuing bond in the middle of COVID, many other issuers and sectors that can access the market these days. Another quite important dynamics and element that we need to participate in and be aware of is obviously financial institutions. Banks till 2018 have been pretty much funded only by deposits and Nordic and local deposits. And when Luminor emerged in 2018, and also we had covered bond development that was triggered by issuance from LHV and Luminor in 2020, it has become quite sizable market. Banks will continue to issue MREL related liabilities. It's medium requirement for own funds and eligible liabilities. So we will issue so-called bail-inable debt to ensure that the balance sheet is protected from liquidity shortages and is more sticky. What we haven't seen so far, and actually something we are so much looking forward, is subordinated debt, and maybe Aare will elaborate a bit on subordinated bonds from local banks targeted to local community, but we haven't seen a subordinated bond from the Baltic Bank under international format so far. Unfortunately, today the environment is not supportive for that. Pension funds, if Dalia will allow us, we can discuss it a bit later, but the message, pension funds, we love you, and without your participation, none of this, what I presented before, would have probably been possible. So it's a really, really great contribution from you guys in terms of debt side of things and market development. But there are some challenges that we can discuss a bit later as debt originators that we are facing in terms of attracting pension money into the market. I think I stop here. My summary: storm has come, but we are dancing. We continue to be a very robust, fast-growing economic region, and I think it is a very bright future for Baltic capital markets. So we'll continue to fast develop and grow. Thank you.
Thank you, Paulius.
How much time I took?
I just would like to encourage to send the questions to the panelists and also to our case studies presenters. Just don't forget, and it is the most exciting and valuable discussion when we have an interaction. But coming to the background, Paulius has presented, let's say, what was yesterday is the history from which we can just stand up. Like in previous panel discussion also was good conclusions from Ivars that we do not need to expect there will be always flexibility and we never stop in one place. So Aare, I would like to ask you, we have storm, we have waves. What kind of issues and issuers in the coming future, midterm perspective, you think is the best time to come to this market? Which issues and companies you would encourage to think about this, to bring this question to the management board and to start this process?
Yes, thank you. And labrit or labdien, I guess, already. And I mean, exciting to be in Riga. I mean, we just talked, with lots of people before that, when was the last time the conference was really held in Riga? I mean, this type of capital markets conference, I don't recall, 20 years ago when I was, 1 year old maybe. So yes, I think it's very important to have this discussion here exactly, and not just only focus on. So I'm going to have a long answer to your question. Is that okay? Not to focus only on, specifically about Estonian, Latvian, or Lithuanian market, but in a capital markets, we definitely also on the bond market, we definitely are talking about the Baltic capital markets. I mean, from the investor perspective, yes, of course, there are some home biases. I will talk about it a little bit later, but in general terms, for the, let's say, individuals, private individuals, family office type of investors, they regard the markets pretty much in the same way. So what type of companies and issuers? But let's then just maybe reflect and add on, what Paulius already showed on the slides. Yes, there is a storm, but, come on, I mean, in ocean or in the sea, there is always somewhere, a bit of a storm here, right? And the good news is that maybe if you compare the Baltic capital markets, let's say, to the, European ones or institutional market, then it's, the dynamics in the process has been so much different. I mean, again, 7-8 years ago, there was nothing on the market really, on a local market at least. Very few issuers, very kind of few selected and kind of brave investors on the market, and look where we have reached. I mean, last year in 2021, there were, Paulius just showed 2 billion, around 2 billion, new issues, basically from the Baltic issuers, and that includes then also the issues on a foreign or on a European capital markets, but locally around 1 billion new issues actually were released last year, and that has been like triple issue size altogether, issue volume altogether compared to the last years. So tremendous, and it's not only about the financing companies, the banks or credit providers, lenders, which are very important visitors to the capital markets, obviously, because otherwise how they can grow in terms of providing and increasing their loan portfolios. So there are plenty of different companies, real estate related, service related, financing companies last year. And if you look at this year, then what do you think? Where are we? We're actually on a very good shape. I mean, even compared to the last year, I mean, 660 million worth of new issues have been actually done in the Baltic capital markets, which are registered in a local Nasdaq CSD, which is not bad. Of course, last year 24 new issues, this year 11. I don't see we are going to reach those numbers for obvious reasons, but this is definitely not a bad news for the companies who want to come and tap the capital markets today. It means that investors are there, the good stories are still selling well. Of course, the companies need to be a bit more selective, but let's come to that a bit later. This is just a general answer to your question, so I'm going to let others to speak as well.
Thank you, Aare. Kristiana, as Paulius works a lot with the institutional investors and with the big issues attracting where we need those core investors, you are working and you are leading mid-sized companies to the market. What your future view would be, whether retail investors are still interested in investing in those bonds, how do they feel those waves in the sea, what their upcoming behavior could be?
Thank you, Dalia. I think it's quite important to actually point out that there is a bit of different maybe investor base and the transactions quite differ when we talk about the institutional transactions, which are north of, let's say, 50, 100 million, where it's important to have foreign investor base and so on. And then for the, let's say, local transactions where we have small and mid-sized companies primarily raising money from local investors, private investors and also local institutional, but primarily Baltic investors. And we've been very happy to see increasing activity on the private investor level, also in bonds, not only in equities. Maybe in equities it has been, even more pronounced, and in bonds, deals are typically made through private placements and not that often as a public offers, but still also the public deals, they show actually good success and interest from investors. So we've seen this interest and activity going, and I think there's still, despite kind of the storm that we are currently in, there's still potential because there's wealth accumulated in the Baltics and it needs to be allocated somewhere, and in these times sitting on cash at the 20% inflation rate is quite expensive, so we see people still looking for the right investment opportunities, and that applies both to private investors, also to Baltic let's say local institutional investors. So I think there's still for the right, let's say, projects, maybe investors are getting a bit more selective, maybe demanding a bit higher, yields, not a bit, but higher, but that still there is quite a bit of potential in the local market.
Let me add on actually to the investor side. I think you raised a very important question because always, when us as originators, we are trying to kind of, tell the company to come to the capital markets, issue new debt, use the money for the growth or refinancing, whatever, then, we're trying to kind of and also think, okay, whom do we place it to? I mean, is there a demand for that? Is the story solid? Is everything, in place or whatever? So basically, I would divide, again, and please add on, I would divide today the investor groups into three. Again, I'm talking about mostly local investor base. Paulius, you definitely are working, mostly with the international institutionals, and that's a little bit of a different story, but let's say the local investor base, I can divide it into three. First, there are institutions and the like, or let's say, very professional investors, mostly, pension funds, and certain family offices. And then there are high net worth individuals is the second group, basically, where the wealth have been accumulated, through, I don't know, the dividend payments, doing an M&A transaction with the company, and now investing their money. And then there are, of course, the retail investor base. And they're a little bit different kind of approach and different views, from these investor groups right now. If you're talking about right now, then again, I would say that institutionals, they're the most skeptical ones today. Again, if I'm wrong, please correct me. But they're very careful, very selective, and also in terms of the institutionals, they're not enough in the Baltics. I mean, this is, where we're lacking definitely the cornerstone investors. I mean, sorry to say pension funds, but guys, I mean, we need you. And not only pension funds, we need, cornerstones, we need, bigger asset management companies to step up and really kind of, also start doing, deal making. And we see that some of the cornerstones, some of the institutions are doing that, as to mention LHV pension funds, for example, great expertise. It takes time, it takes, courage, to do that, but, we are lacking, this type of investors on the market. But in spite of that, we still are, breaking the records in terms of, the bond issuances. Second group, high net worth individuals, I think this is, something that has grown a lot in the past, 10, 15 years. Remember 2009 and 10, no money, on the streets, in the banks, in the companies. It was awful. Right now we can, enjoy the greatest deposit growth ever, in the past 5-6 years, double digit, right, in all Baltic countries. Okay, now it has slowed down for sure, but wealth has been accumulated, and this is, what actually, and they are bringing it back to the economy. The question rather for me in most of the time is, do we have enough supply of the products? So I encourage the issuers to come to the market because, there is investor groups who actually would like to invest, and they are, not always, with the same face and the same kind of, appetite, They need different things, Some want to have more exotic, more risk. Some want to have, more stable, more kind of, I would say, stable companies. So they're different. But those guys are definitely today very important investors on the market, and they are driving today the prices. I mean, if last year, I don't know, just to pick an example, the same, the bank's subordinated debt, as Paulius mentioned, the big bank which just, recently did the public offering of the bonds, maybe last year they would have, done it at 6%. 10-year bond, subordinated, this year it was 8%. And this price is not really,
still very attractive.
Still very attractive.
From broader perspective.
Yeah. And the third group is, and then I shut up, and the third group, of course, retail investors. And for those guys, I mean, we need good stories. Consumer brands, I mean, not only banks, companies. Indexo, good example. I mean, they have, their kind of a client base that they have the story to tell to. So, and they're still there. They're not gone. Last week, big bank, 20 mil oversubscription. I was a lot of retail investors, chipped in, more than 1,000, 1,500 even. So, so we have those three groups that are actually playing a key element, and you need to cater also to them differently. But there are always possibilities to supply and offer the bonds for all the three different investor groups in the Baltics.
Paulius,
if I just pick up on the pension funds, actually a couple challenges I would outline. And I'm criticizing it with every opportunity privately and also publicly. And Estonian government, what they have done with the pension system, last year is a disaster. I mean,
Paulius said it, not me, but
I can afford to say it because I'm Lithuanian.
I agree with him.
I hope you haven't.
Basically, the whole spirit of long-term savings was destroyed in one decision, right? And the money that was supposed to play in capital markets development was used on cars, washing machines, casino, you name it. It definitely was not rooted to investment. And from the transactions I presented here, guess how many? What was participation rate from Estonian pension funds over the last 2 years? 0 to none. And it used to be very powerful investor based on the debt side and very geared towards debt side of things. And actually, it's another point I would say that Aare picked up a bit, I can elaborate a bit, is when you know how pension funds are built and organized, there's pretty much only one pension fund that was mentioned before that is geared to single-name private debt investments, right? The other guys are more passive or focused on very high-quality liquid stuff. On the other hand, you kind of understand the logic, you understand the asset allocation approach and also the cost efficiency. And probably it would be naive to expect that we would be investing in tiny 5 million, 10 million euro issues, right? We don't simply have resource for that. Just like we wouldn't look into single-name private equity investment, right? But we are happily investing with Baltic and other guys, you know, who play in that field. So I think what we are lacking, and it will definitely boost the capital markets, is privately owned, actively managed, professionally managed funds that are focused and acting locally. And we could attract pension money, we could attract money from supranationals. Obviously, we need a very high quality vehicle to make sure we have all the ESG elements, Baltic focus, and we could probably also attract retail money actually into that vehicle. And professionally managed funds could allow retail money to channel through and access local transactions on the debt side and equity side of things. So I think this is the key trigger for next stage of development.
Yeah, maybe just a brief remark from my side. I basically quite agree with everything that Aare and Paulius already said, but just to note, I think that there's really a kind of lack of this institutional investor in this, let's say, small to mid-sized deals, right? And also what is not always understood is that exactly the pension funds have outgrown the kind of local capital markets quite a lot, and they are not the investor in these deals. So I totally agree on that sense that the more we have let's say either private debt or local market-oriented debt funds on the market, and this will be very helpful. But I also think it's in a sense a bit of a chicken-egg problem. We didn't have that much choice before, having a limited choice in terms of sector representation and everything. Now when we have a greater number of players on the market, so there's also a choice from the investor's perspective. So it starts to make sense actually thinking about setting up such vehicles. So I think, and I actually see some initiatives as well that these type of funds they will appear, and they will provide additional support to the market, and they will also provide for the retail investors kind of diversified vehicles, diversified exposures, professionally governed vehicles, how they can actually get exposure to the market.
Let's maybe mention a few other things as well. I mean, the issue sizes, which is important again, if we're talking about, or if you want to address the issuers here, right? And also the trading element of that, which addresses maybe the kind of investor interest and appetite, which we haven't talked about. It's more obvious. Trading is more obvious, with the shares, right? I mean, like, it's very easy, to follow, and as Ivar said, basically it's very easy to kind of, go and trade, through any of the internet bank, and then you see the price and you understand the logic. With the, kind of bonds, you see the bid and ask, and it's like, what's the price? Or what is the price? But anyways, let's come back to the issue sizes. Yeah, I mean, I've heard a lot of those questions. No, I'm too small. It's no point for me to do the bond issue. It's a lot of cost associated with that. So we're going to probably hear about the story today that everything is fine, right? I mean, but so what are the kind of the typical issue sizes? Again, I mean, I would divide them into three, and then my colleagues, please, challenge me. I mean, with the larger bond issues, Paulius, you feel more familiar, but I would say anything above 20 mil, this is, it has to be either the kind of international placement or co-placement with some, I don't know, Nordic placing agent, or it has to be kind of a public offering of the bonds. As somewhat like mid-size, it used to be before like up to 5 mil, now it's more like up to 10 mil. So I mean, up to 10 million, you can do pretty much, good, and it's a very good size of the bond issue in the Baltics, and for the company to use this, for the growth or refinancing of the other debts, and this can be done pretty much, without, I would say, even a public offerings or without necessarily the big cornerstones. And the smaller issues, 2, 3, 4, 5, up to 5, they're very kind of, I would say, natural to do. There is a good flow of offerings on the markets. Investors are used to that. There is a standardized, documentation for that. There are plenty of originators, distributors on the market, and also I think the law firms. Maris, where are you? I need your voice. Yeah, just support me, please. I mean, and law firms, they are, very well aware, and then they have a standardized kind of, services and packages also offered. So I would say, different sizes, they go very well for different companies.
Thanks,
I would
Aare.
just quickly argue that probably the bar is a bit higher. We have proven that we could do 50 mil. I mean, obviously, then it's super important to try to have some anchor accounts. Ideally, if you could get supranationals on board, then it also easier opens pension fund doors. So I think it could be a higher number just for local effort.
I know, guys, I was informed before that discussing with you, we could last for 1 hour,
yes.
for 2 hours, etc. But I would like to invite you, Viktorija, and to present your case and share your experience, because I think this is the most valuable information for upcoming issuers to share this.
Okay, hello everyone. I think I'm that issue falling between the chairs. So we issued 5 million euros of bonds this year, and I'm going to tell my story, which it is like a bit of the fairy tale, mostly focused on the good things and just a little bit on the difficulties we had on the way. So shortly about us, maybe we are not so well known for everyone. We are #1 player in the Baltics in the professional coffee service market. Our revenues are around 40 million euros. We have 14,000 machines, coffee machines, placed in the different locations. 300 people work for us, and we are 100% owned by Baltic. This is maybe a better representation, easy representation of what we do. Most of our business is in the vending. We are located both in public and private locations. We also work a lot with retail and convenience, with the gasoline stations, providing them with the private label solutions for their coffee offering. And we are also placing or servicing offices across the Baltics. So, about our bond issue, the most fun part and the most relevant part for this conference. At the beginning of this year, we were faced with a challenge that although we have relatively low leverage overall as a company, we still did have unproportionately high share of that leverage into the short-term loans, which we would understand place an undue pressure on our cash flows for this and for the next year. So we were kind of thinking of what to do with this, and of course the most obvious choice would be to go back to our bank and to renegotiate the terms. And quite accidentally, I actually participated in one of the Signet events as a customer, and I've heard about these bonds being issued by the corporate companies, and I thought, oh, maybe this is something that we could actually consider. And then, the conversation after the conversation, this quick idea turned into the reality. So we issued 5 million euros of bonds with a 3-year term and a fixed interest rate in first half of this year. The money was in our accounts in the first days of July. The issue was oversubscribed. We had around 25 investors in total, and there's a quick 2 pie charts showing you the allocation between the institutionals and private investors and a split across the countries. So the key learning points. So the key learning points. What was easy? Why we were successful is it was specifically noted that Baltic ownership helped a lot. Because of course it provides a certain stamp of the quality on the company, on its transparency, on the corporate governance processes, and also there is a certain and continuous due diligence performed already on us by quite professional investment team. We also have a very strong market position. We are number one, as I explained, in the market with a quite good visibility across all the Baltic states, not just one country. And we were different. Most of the issues, what you see is it's actually the split was a bit different, but my perception was that it was also, before, that it's mostly either financial service companies or real estate. So we were in a sort of real business, and that was interesting, especially for the private investors who were looking to diversify their portfolios. And of course, I think that quite crucial was because we were newcomers to this market, so it was something very unknown to us as a management team. It was important that we had a very high quality advice from professional advisors. We worked with KPMG to present our financials in the best light, with Cobalt, who prepared the prospectus and the relevant legal documentation, and the Signet bank, who was actually leading or arranging the process. A bit of the, of challenges that we faced during this process. Overall, it was quite smooth and quite quick. It was 2 months process, not actually longer than it would take for us to renegotiate with the bank. But it was also ambitious, of course. So the timing was kind of short, which means that many processes were happening in the parallel. And what we maybe didn't understand fully is how long it will take to actually agree with our existing lenders for this new issue. So as I said, as we were doing things in parallel, the negotiations were happening with a parallel, and we already have quite extensive portfolio of lenders. So we have also government institutions and banks. So we basically were obtaining the approvals to issue bonds literally last minute, last evening before the subscription deadline of the bonds. We have quite complex financials because we, as a group, we are the result of the merging of the 7 different companies. Plus, during the COVID years, there was certain dip in our kind of financial performance. Plus, there is a lot of kind of technical items on our balance sheet and profit and loss, like a goodwill. We have a quite large depreciation, which actually for the non-professional investor is kind of hard to understand. It's hard to read our financials and understand the real underlying value of the business. And last but not the least, we were just finishing our issue before the sun was already shining and the sea was warm, and of course attention of the people in the summertime is starts to get somewhere distracted and to be somewhere else. So we were really rushing to complete the issue before the vacation period starts before July. Yes, so this is overall quite enjoyable process, quite interesting process, easier than what we thought. And we were testing the ground with quite a small issue. Actually, it was we were discussing quite a bit how large part of our existing loans we should refinance. And we decided to start with relatively small to test the market, to understand, how can we deal with this as a management team, and considering the good results we've got, the plan is to continue going this path also in the future. Thank you very much.
Thanks, Viktorija. Nevertheless, if I may ask you some additional questions, I know that the companies at the beginning, when they start this process the first time, the eyes are big. Then at the end, satisfaction. So how you would assess in your company, because process is not for the process, and transaction is not for transaction itself, whether it has met your expectation at the end?
I would say it actually exceeded our expectation. Because first of all, we were very concerned because we didn't have, none of us from the management team, also from the shareholders, have had similar processes in the past. So we were not really sure how complex it will be, how time-consuming it will be, what kind of resources it will require from us. And because we were kind of, well-prepared, well-managed, with a transparent corporate governance as our kind of daily standard way, modus operandi, the whole process was relatively easy and easier than we thought. And the side effects and side benefits, there are also these really, I would say, beneficial side effects which we didn't expect before. First of all, it's we as a company are really proud that we were able to raise, sell these bonds, and actually there was an interest from the market. And we are proud as a management team, but also as, a wider kind of group of employees, because now it's a bit of a different standing of the company when you are already quoted on the stock exchange. We will be in the next months, not yet technically, but soon. So it's a different. It kind of brings your company into the different status just from some average, maybe middle market company in the Baltics to the quoted company. And it also gives an opportunity to talk about our company, actually. I'm sitting here on the stage, lights in my eyes, and talk about the coffee address, the company I really enjoy working for, and I would not have had this opportunity before. So I think in terms of, showing kind of your company in the best light, both outside and from inside, is unexpected, really beneficial side effect of all this.
And one more practical angle, looking from the management. If you would come to the other company, at which moment you would brought this question to the management board to think about raising capital in debt capital market?
I think the company, as I said, I think the company should be well prepared. So I think if the company has certain internal challenges with the corporate governance, with the financials, with the liquidity, with the, you name what, there is a lot of internal kind of things going on. I think this is not the right time. You have to be you have to be prepared. You have to be quite ready for this. We didn't think about us in these terms, but now I clearly understand that we were ready. We were kind of ripe for the capital markets, if I can say so. This should be like the prerequisite, and also then you need to understand why you are doing this. So you are doing this to kind of go for the new projects, for the new markets, or you are trying to reshuffle your existing leverage. So what is actually the reason for this? And then of course the market conditions. We were, I think, kind of stepped in the last this car of the train that was leaving the station. So we were quite lucky. I understand after us it's a bit more difficult for the corporates to raise money at those terms. We were lucky to have them.
Really this nice moment, but Kristiana, I wanted to ask you, because now we are talking about those small size issues, up to 5-8 million, where retail market could work with it. So really it was the last chance to step in, and now we do have a break.
No.
Whether retail is still ready to be in this market?
Yeah, actually, maybe just a remark about the coffee address case. I think what Viktorija said about the quality management and about the reputable shareholder, it really actually helped to also attract interest from institutional investors, despite the small size of the deal, which was like 5 million, and traditionally it's placed among private investors, almost like in many cases, it's just 100% placed among such size among private investors. In this case, we saw quite a large interest from institutional investors, and I also think that the fact that they really appreciate kind of diversity, a different kind of proposition that was coming from what we usually had on the market. So this was not a typical kind of deal where the retail participated, and it was also a private placement, so just 100,000 minimum investment. So basically, it's more for the high net worth individual type of private investors that participated. On the other side, and no, we do see definitely there's still interest, as we discussed previously. There's still money, there's still interest from investors, but of course, you know, the expectations are changing a bit. You know, if we're talking about coffee did a fixed rate transaction, so what we currently see is that there are increasingly more frequently floating rate bonds issued, so where the kind of interest rate risk is passed from the issuer, from the investor to the issuer. So this probably wouldn't kind of work out now, and the interest rate would probably. So when we kind of did this, it seemed that, you know, the market was worsening day by day, and we still kind of pulled this off, and everything went on, I would say, successfully as well. But today probably the rates, you know, would be higher. So it's kind of.
No, I think you know, I said that we stepped in the last car of the train, in the train that was kind of the old world train in a way, and it doesn't mean that the new trains will not be coming into the station, but I think that at least after a while, but the conditions might be a bit different, so we would have to get used to that.
Can I comment as well?
I know that you are optimistic.
Can I?
Yes.
Can I comment, please?
Sure.
No, I mean, I'm not a train specialist, so I cannot comment on that. But I mean, again, a very good example of the issuer and the companies that definitely are expected to the market. And again, I mean, you know, you talked about a few of the reasons, you know, why you did it. Maybe to add on top of that is definitely that, I mean, if someone might ask, I mean, 9% quarterly payments, interest, I mean, it's low, high, it's just, it's not, you know, it's not a low interest, right? I mean, it's high yield, at least in European terms, also in the Baltic terms. But keep in mind, I mean, a lot of the reasons why companies are going to the market, you know, for the bond issues, it's partly to substitute also the equity. I mean, you leverage yourself a bit up, you know, you still, your weighted average cost of capital, you know, is well managed. I mean, also in some of the cases, you know, you kind of also, you know, show it to the banks that, you know, I can do it. I can do it outside of the, you know, the banks. So it's you know, I have the kind of, you know, power to kind of, you know, go to the capital markets if needed. If needed, I, you know, go to the banks. A combination. Maybe the combinations do not work very well yet, you know, for the mid-sized companies and the smaller companies in the Baltics. There's a little bit of a resistance, you know, going still on, but I think we'll see it more and more. And of course, you know, if the company wants to go, you know, public at one point of time, you know, also doing, you know, the listings or technical or what's not, you know, let's not use the word IPO as Ivar said, then, you know, perfect, you know, way to kind of go to the market with a fairly easy process of what you said, 2 months, yes. I mean, typically 2 months is to do the private placement process. Of course, you know, if you do the public offering at the same time, it takes more time, you know, because of the prospectus requirements sometimes if it's a bigger issue. So, but yeah, those are the reasons, and I think you know, we see you know, we see a lot of those you know, at least we see in a pipeline companies coming in that are not just necessarily financing companies or the banks or credit providers who are the typical bunch, but also, you know, great service companies like Coffee Address and please welcome. I mean, the pricing, of course, you know, we cannot predict. Goes up and down, the market is dynamic, yes, also in the bond market, but I wouldn't say that this is anything kind of, you know, that we need to kind of overreact. The market is there, the investors are there, again, there are different groups of investors, different stories, but, you know, things are doable.
And this moment, I will ask Paulius to share its company experience on sustainability issues, which is coming like every day, is coming to our everyday business. And please share with the companies those tips which you shouldn't consider going further.
Thank you, Dalia. Labdiens, it's great to be here. It's a great honor for me to present our sustainability-linked bond issuance. So first of all, I would like to present you and to inform you about where we are coming from, what is EPSO-G group. Basically, we are the group of energy transmission and exchange companies, which is owned by the 100% of the shares, it's owned by the Republic of Lithuania. The main shareholder of EPSO-G group is the Ministry of Energy. And in our group, EPSO-G is a parent company, which is responsible for the governance of 6 other companies. So first of all, we have Augaite, which is the gas transmission system operator, which also has a daughter company, Baltic, which is an operator of the natural gas exchange in the Baltics and in Finland. Second, basically the largest part of our business, largest part of our EBITDA comes from operations of Redgate, which is the energy transmission operator responsible for interconnections, for the synchronization with the continental Europe networks. Then we have Baltic, which basically operates the exchange of biomass and the heat. In the Baltics, we have Tetas, which is the construction company which operates in the field of constructing various parts of the power grid, and Energy Cells, the newest company in our group, established only in 2021, which is responsible for the building the 200 megawatts of batteries, energy battery capacities in Lithuania. And basically, we have a major role in Lithuania. So we have to enable security, integration, and the transformation of Lithuanian energy system. So basically, the security is to ensure that our energy flows, both natural gas and electricity, flows reliable, consumers don't have any blackouts and so forth. And integration, of course, it's disconnection from the BREL network and connecting to the grids of continental Europe. And transformation is the last, but I think the not a very important role and very important part, because it's the transformation of the whole energy sector, which is moving from this linear one-way energy flows to the circular energy system, where we have tons of renewables, tons of prosumers, consumers and producers, which are interconnecting, and we have to invest in grids, in infrastructure to enable this transformation. So basically, how we do it, of course, we have an ambitious investment program, 1.6 billion over 8 years, up to by 2030. And basically, the major part of this investment program, of course, comes to the modernization and the maintenance of transmission grids. So basically, we have to prepare the grid for the integration of large parts of renewables, onshore wind farms, onshore solar farms, offshore wind farms, and so forth. Of course, synchronization of the continental European networks is very important in terms of ensuring the energy independence of Lithuania. Some part goes for modernization and maintenance of gas transmission network, and some goes to the battery projects, and of course the hydrogen, the new type of fuel, which is very trendy right now in the energy market, and some small part comes to other investments. And basically all the investments are aligned with the national energy targets, energy strategy, so we have the need for money. Basically, why sustainability-linked bonds? Because there is, of course, as it already been told here, we are a utility company, kind of utility company. We can go easy with green bonds, but there was not an option for us, because in our investment program we have not only the utilities, not only the grids, but other needs as well. So basically we need we will need to go with the sustainability-linked bonds, which allows us to use the proceeds for general corporate purposes. And of course we wanted to diversify our financial portfolio, because basically up till the issuance of the bonds, the main part the projects, energy infrastructure projects were financed by the bank loans, by the grants, congestion funds, and so forth. And of course, we had quite high credit rating, quite good EPSO-G credit impact score, which was given us by Moody's. It's neutral to low impact. And of course, we had sustainability strategy in place, and so basically these are the all parts if you want to go with the sustainability-linked bonds. So basically, we have these EPSO-G sections of sustainability covered. Basically, we have 3 clear directions where to go in terms of environment, social, and governance, and we have those linked with the sustainability development goals, which is established by United Nations. And of course, these directions have separate KPIs, but unfortunately I don't have the time to go into detail. I would much appreciate to do so, but unfortunately I can't. And the setup. So basically, what sustainability-linked bonds needs, and what is the second most important document in this process is sustainability-linked finance framework. And what is most interesting about this document, that it has the word finance in its title, but it has no words whatsoever related to finance in the whole document. So can you believe that? Basically, I'm bluffing, just, yeah, it has only one sentence. The sentence is written in red. It is regarding the use of proceeds, and we put in that after the discussions with the institutional investors. And basically, this document is about your sustainability strategy, your sustainability achievements, your sustainability KPIs you select related and material to your business, and your sustainability performance targets, which will be linked with step-up mechanism. So this was a step-up bond. And we have basically 2 KPIs. The first one is, of course, because we come from the energy sector, and the energy sector is one of the most polluting sectors in planet Earth. And so we decided to go with CO2 emission reductions in the whole group, in our own operations. And of course, we linked one of the KPIs with keeping the high reliability of our transmission network. So, and our sustainability performance targets were 50%. To reduce our emissions coming from our own operations by 2030, and to keep the amount of energy not supplied below 136 megawatts. And of course, we had a second opinion, which was provided by the Cicero's Shades of Green, a Norwegian company. They are a strict company, and they do not just read the nice story you had in place in the sustainability-linked finance framework, but they ask you a lot of questions. Measuring is your framework in line with Paris Agreement? Do you have any emission factors validated, and so forth and so forth? So basically, it's been a quite long period for us to introduce our framework, because energy sector has quite the specifics we have to introduce for second opinion providers. And basically, yeah, they found out that they confirmed that the framework was aligned with sustainability-linked principles by ICMA and sustainability-linked loan principles by ICMA, and it led to the results we achieved. We raised 75 million euros. We have 5-year bonds with a yield of 3.117%. And we became the first company in the Baltics who issued the sustainability-linked bonds. And basically, the bonds were purchased by the international investors from Lithuania, Latvia, Estonia, and Sweden. And of course, a few key takeaways for issuers. So you have to be prepared. You have to not only have ESG strategy in place, but also emissions counted for scope and 2. Free, preferably, of course, to talk with institutional investors early, because they will have some issues they want to address, because a lot of them now has environmental, social, and governance policies updated in terms of Paris agreements and other European regulations. So we have to hear them, what they need, what they want to invest in. Are there any red lines for the investments, and so forth. And of course, be not afraid to go with the stricter second opinion provider, because you have to learn something from them, what you have to do better, where are your weaker parts, stronger parts, and so forth. And of course, be ahead. So you have to do the taxonomy alignment, net zero pathways, climate transition plans, and so forth, because if you want to receive impeccable second opinion, basically, for your financing framework, this is a must to do. So basically, this is it for me. Thank you.
Thank you, Paulius. Thank you for sharing this practice. But again, practical questions. I'm saying that to have documented once, to become listed company is the second point, but in practice, how it has changed your company's daily life. When did you sleep better? Before listing or after? Before this framework is issued or after?
Yeah. So the answer is quite easy here, of course, after. It took 5 months for us to prepare for this issuance, because one team were doing prospectus, one team were doing sustainability-linked finance framework, and of course, together with all our team, we have included in discussion with the second opinion provider, and we're trying to explain what we are doing and what are our KPIs, how are they related to the climate issues, and so forth. But basically, the decision was made by the board to go with sustainability-linked bonds issuance, I think, in the end of 2021. And we were kind of preparing, because the market, as Viktorija already said in her story, the market was quite good, conditions were quite good. And basically, then the war started, and then we got cautious, but nevertheless, we went with the issuance in the end of the May, basically, and it was quite successful. So basically, yeah, there were lack of sleep during these 5 months. So, but it is now much easier. Of course, we have to prepare we have to how to say, strengthen the EPSO-G management now, because we are in the Nasdaq, listed in the Nasdaq, and basically we have few more obligations to our anchor investors, which we have to achieve.
So as you touch this angle of anchor investors, and I do understand that still green sustainability-linked bonds, they are more actual to bigger size of issues. So Paulius, what would be your future insights? Green and sustainability features in the bond issues will be nice to have, keeping in mind that we have this energy crisis, and etc. What is your view?
I think today, in today's environment, it's extremely hard to position yourself and to market a debt transaction to institutional community without any kind of ESG element. Either it's SLB, green bond, or a very clear ESG strategy that is presented by the company, and ideally also externally rated by external verified opinion provider. But maybe my remark on what Paulius presented, I think ESG is serious, it's not a joke, right? And the way I would approach it from a company perspective, it's not tactically. There is a lot of temptation to approach it tactically and just, make sure the docs are done for the sake of issuance process, and we forget about it. It's really a strategic choice, a strategic ambition, and it's no longer tactical, but strategic approach. It has to become your DNA. And it starts with really the goals, what you want to achieve, by 2030, 2050, whatsoever. It has to be captured in your strategy. And obviously, it's not just about about climate neutrality, right? You need to obviously think much broader. You need to think about inclusion, equality, governance, transparency, communication, corruption prevention, blah, 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 blah. All those things have to become a DNA of your organization, how you function. And then, if you have those, if you have solid foundation, then sustainability financing framework and green bond framework will float out of it very naturally and quite easily, actually. So my advice in a rainy day, it's actually a very good opportunity to position yourself and to prepare the company. If you want to become a borrower in financial markets, it's exactly good timing to get preparation started already now.
Aare, would you like to add something before I will ask Richard to come with the questions from the audience?
No, just maybe what came into my mind was that I suddenly started to compare the Baltic equities and the bond markets, and I see a few differences just very shortly. First, if in equity markets you can see big issues from Lithuania, Estonia, and suddenly a lot of IPOs, small ones from Estonia, then actually the local bond market, again, not for the international, to mix it up with an international market, local bond market is actually pretty nicely divided between Estonian, Latvian, Lithuanian issuers, which is very nice. Again, it allows different companies from different markets to come to the market, and the market has showed it already. And also, if you look at actually the number of listed bonds on a Baltic bond list and on the First North, and actually there are more than the shares listed. There are actually more bonds on a main list, on the Baltic main list, and also on the First North than equity, number of equities there. So it shows something about the local bond market as well, and issuers are welcome. Again, there are plenty of originators. I mean, ones that are here on a stage, with the Luminor markets, with the Signet, with the Redgate Capital, but then, you can talk also to, various other originators. Please, talk to them, because different originators have different views and different appetites sometimes and strengths. So there are today definitely a good time to prepare for the new capital raise, for the next year.
Thanks, and Robert, I think
Yes, Dalia?
let's listen what audience is interested in.
Audience is asking a lot of questions actually, but we don't have that much time, so probably not all the questions are going to be answered. But there are a couple of very practical, quick questions I would like to ask first of all to Viktorija. How many members of your team participated in the preparation of the bond issue? Internal resource.
Internal resources. I think up to 25.
Whoa.
Up to 25 people, because we had to include not only the people from finance, lawyers and so on, but also to include the guys from the transmission networks operation. So basically Ambergrid, Redgate, those technical guys, they also had to be included because we had to do this calculation explanations in the human language, what we do here and so forth, so investors would believe it.
So the size has increased because of the green element, right?
Yes, yes indeed.
Okay. And
Viktorija?
in your case, Viktorija?
I somehow have to turn this question into a joke because we are owned by Baltic. We are very, very lean. I think it was two of us, me and my CFO. She's hero in this story. She's somewhere in the audience. I tried to search for her, and she has a birthday today as well. So happy birthday to you!
Happy birthday!
Happy birthday!
But yeah, and we were then outsourcing a lot of help was coming from our advisors.
Okay, so it's only one person, right? The answer is?
Yes.
Okay.
It can be done by one person.
Okay, then the interesting question, I think, is how much this SLB status has affected the cost of borrowing. I mean, if you can provide this difference in the interest rate which you have gained because of having this SLB status for the bonds. If you made such calculations.
No, we have not.
You can't. Okay.
But Paulius,
I was not involved in the deal. I can just comment from the side. I probably afford to be even more brutal. I would say that without SLB element, at that time, it would not be even possible. So I think it made the transaction happen, actually. It was the element that made the door of various investors open.
Okay.
If Paulius says so, yeah. So.
But this is just my humble opinion.
Okay, what are the costs of bond issue? If you can disclose it.
Unfortunately.
Because we've heard about the equity placement in the previous case studies, but I assume bonds could be a bit cheaper. But
I can maybe disclose. I mean, for the let's say mid-size companies, again, I mean, mid-size issues, 5 to 10 mil, let's say, 2.5% would be kind of, success fee, and then from the financial advisor, maybe a one-time retainer, maybe not, depending on a competitive situation, especially. So, I mean, it has to be competition always, between the originators, and then probably the law firms, they take what, if it's not a public issue, but private placement, then what, 10,000-15,000? Maris, maybe, or you can comment. Something like that.
Small issues, yes.
So that's basically about the small issues. Again, I'm not talking about maybe the big ones.
I think, I cannot disclose, I think it would not be fair to disclose the exact numbers, but I think it does not increase this effective interest rate materially. So this is the way we look at it, and we kind of look at the totality of the cost for this.
Mm-hmm. Thank you. And there is another question related to the technical access to the bond market by retail investors in the Baltics. And I think it's more of a question to the bankers. I mean, whether there is anything which can be done in terms of making this access easier, because we all know that large and small banks, they don't really provide sort of very easy web-based access to trade Baltic bonds. So is there anything which can be done about that?
I suspect this question is coming from a perspective that typically large international debt offerings are wholesale only, meaning that this is under the spirit of MiFID regulation. The target market is strictly set to wholesale, which means eligible counterparties or professional investors. And those bonds are simply not available for retail investors. And the overall idea of MiFID, that retail investors should be able to access it via professional managed funds. So this is unfortunately, I think, will be very hard to change, the accessibility of wholesale bonds to retail. Unless we change MiFID, which would be a good idea, actually.
Yeah, maybe I can just add on
The next
bit,
topic.
About talking, let's say, not about the wholesale bond, but more about the local bonds. I think what was also meant by this question is that it's, if we compare shares and bonds, it's much more difficult to actually buy a bond on the market than it is for shares. It's more difficult actually for the investor to really understand what he or she needs to do. Some of the banks don't really offer like a very friendly service, and it costs more as well. So if something could be done on the retail banks to kind of to align this process as much as possible with how it goes currently with the shares, that would definitely be beneficial for the retail investor activity and also for in general for private investor activity investing in local market bonds.
How many of you have filled out the appropriateness test in a bank? Okay, we have few hands, but even here, in this crowd, there are not too many. So meaning that you haven't been even access, to some of the offerings on the market, bond offerings on the market. So I don't know what's the deal. I mean, we're constantly talking, of course, to the distributors. A lot of time, banks are distributors and the good cooperation partners, us as originators. And some banks are also originators as well, like LHV, for example, which is fine. And I think, the ones who have more experience, they definitely, improve it all the time. So hopefully it will improve, all the time. And in 5 years' time, there will be no question like that anymore.
Yeah, I think we can conduct a separate panel or even conference on MiFID issues. And we also saw that in Lithuania there was an initiative to actually ease these MiFID II requirements. But the good news at least is that we don't have MiFID III coming over, so it's not going to get worse.
But even, Roberts, on the EU level, also those discussions and problems of MiFID II are raised, so this is really the issue and headache for every country, not only for us.
Mm. I think there are many more questions, but I think we should be...
One final remark, if I may. I really so much enjoyed the morning session on equity capital markets, and the colleagues were at the stage exploring what is the next Baltic elephant transaction from the equity side of things. And I think what we haven't discussed yet is the private equity exits, right? We have, for example, a couple of large financial institutions, private equity owned in Baltic states. Baltcap, other guys in Valda will probably also be looking for some private equity exits. So I think this is really the next opportunity for the stage 2 of capital markets development. So we'll meet in the next conference. I think we can discuss one of those stories.
And the market is always dynamic. There is no moment where everything is stable. So from the banks, we may receive negative decisions from the credit committees on any date. Here we have to catch the window when go to the market, and all the day we have to be prepared for it. Everything is dynamic. So thanks really for everybody for this discussion. Good questions, good answers, and we are optimistic. Aare.